Thank you, colleagues, honourable senators. This is our 5th meeting on our new special study on the access to credit and capital markets for small and medium-sized enterprises as the basis of growth and improved productivity in the Canadian economy. I would like to welcome our witnesses. So here in person, we have Mr. Andrew Creech, the president of TSX Venture Exchange. And I think we have with us virtually, yes, I see him, Mr. Richard Carleton, the Chief Executive Officer of the Canadian Securities Exchange. Welcome, Mr. Carleton. Given that you're here with us by video conference, if there are any technical problems, tell us and we'll suspend temporarily. So I would like to invite each of you to share with us your comments. You have opening statements, I believe, so please share it with us. You have 5 minutes each, and after that we'll go to questions. I'll start with Mr. Andrew Creech, who's here with us. You have the floor. Welcome.
Bonjour, mesdames et messieurs. Thank you to the members
Good morning,
of the
ladies and gentlemen.
Appear before you today. It's an honor to be here. My name is Andy Creech, and I'm the president of the TSX Venture Exchange, Canada's leading public market for early-stage companies. TSX Venture Exchange is a component of TMX Group, which occupies a unique position at the center of the economy. Operator of Canada's premier equities and derivatives markets, the Toronto Stock Exchange, Montreal Exchange, and the TSX Venture Exchange, as well as the critical clearing and data capabilities that enable financial ecosystem. Our Canadian public market ecosystem is often misunderstood. When people think of the stock market, they usually picture large established corporations, but in Canada, most public companies are actually small and medium-sized enterprises. This is unique to Canada and something we should take pride in. Across the TSX and TSX Venture, 58% of corporate issuers have a market cap under $50 million. On TSX Venture, this figure is 88%. What makes the TSXV unique is that it enables companies to access public capital at a very early stage. The most common listing route to the TSX Venture is through the Capital Pool Company Program, or CPC program, a streamlined vehicle that is much more cost-effective for small companies than a traditional IPO. Since the program's inception in 1986, more than 2,800 CPCs have been created, and of those, approximately 86% have successfully completed qualifying transaction, helping bring new operating businesses to the public markets. CPCs continue to play an important role in Canada's listing ecosystem. On average, about 32% of TSX Venture graduates began as CPCs, and roughly 53% of all new corporate listings on TSX and TSX Venture today are current or former CPCs. You heard that right. More than half of our public companies start out as CPCs. But this is only the beginning of the story. TSX Venture is also an important pathway for companies seeking to grow and ultimately graduate to Canada's senior market. Since 2000, nearly 800 companies have graduated from TSX Venture to the TSX. This is how we incubate and grow new Canadian champions, and it all starts on the Venture Exchange. Today, the success of that pipeline is clearly visible in the broader market. Approximately 22% of the companies in the S&P TSX Composite Index began their journey on the TSX Venture. More broadly, 34% of all corporate issuers on TSX are TSX Venture graduates, so a third have graduated from the Venture. These are real Canadian business success stories, and part of our mission is to make this pathway easier to access for more companies. At TMX, our unifying purpose is to make markets better and to empower bold ideas. It's an enterprise commitment rooted in a proud history and focused on ensuring a viable future. Better markets mean more efficient flows of capital, ensuring that Canadian companies of all sizes and across all sectors can fund their business strategies, invest in innovation, and ultimately become the next homegrown global success story. We view it as our responsibility to champion by promoting investment in Canadian companies, strengthening economic prosperity, and supporting global competitiveness. To this end, TMX has put forward several policy recommendations aimed at improving access to capital in Canada. First, we recommend making the Mineral Tax Exploration Credit, the METC, permanent. The METC is a critical incentive designed to encourage investment in Canada's mineral exploration industry. However, it continues to operate on short-term renewals, most recently extended for only 2 years. This cycle of expiry and renewal creates unnecessary uncertainty for companies and investors. Making the credit permanent would provide greater predictability and strengthen investor confidence in Canada's mineral exploration sector. During the recent PDAC mining conference in Toronto, this point was underscored by unanimous consent from mining companies present at the industry roundtable with the Deputy Minister of Natural Resources. Second, we support expanding the use of the flow-through shares to additional high-growth sectors. Flow-through shares are a uniquely Canadian policy tool that have successfully de-risked investment in higher-risk sectors, like mining, and helped establish Canada as a global leader in mineral exploration financing. Expanding this mechanism to other emerging industries like AI or defense would help unlock new investment and support innovation across the Canadian economy. Third, we recommend creating a more competitive tax environment for investment in Canadian companies. As one example, reducing capital gains taxes on investments in Canadian companies would encourage greater domestic investment, improve productivity, and help attract and retain capital within Canada's economy. Finally, we welcome the government's recent improvements to the Scientific Research and Exploration Development Program, which represent meaningful progress in supporting innovation and productivity. For the first time, eligible Canadian public corporations now have access to a 35% refundable tax credit on up to $6 million in qualifying R&D expenditures, correcting a long-standing imbalance that excluded public companies from this key support. The recommendations I've outlined today are practical steps that can help ensure Canada's capital markets remain a power engine of innovation, investment, and economic prosperity. Thank you again for the opportunity to appear before the committee, and I look forward to your questions.
So thank you, Mr. Krish. So I will invite now Mr. Carlton to share his opening remark with us. Welcome. You have the floor.
Thank you very much, Mr. Chair, and I apologize for not being present in Ottawa this morning. Unfortunately, Mother Nature and the Canadian airline transport had other ideas, unfortunately. Although, Andy, it was obviously easier to get in from Vancouver than it was from Toronto. In any event, my name is Richard Carlton. I'm the CEO of the Canadian Securities Exchange. I've held this position for 15 years, and my career in the Canadian corporate finance community dates back to the late 1980s and includes executive management roles with the Toronto Stock Exchange. The CSE is a recognized securities exchange operating across Canada, with primary regulatory oversight provided by the Ontario and BC Securities Commissions. We are headquartered in Toronto with a significant staff complement in Vancouver, and we have staff members in Montreal and in Calgary. The organization is a Canadian success story in its own right. We were a startup in 2002, 2003. We've raised $38.5 million over the course of our existence to fund what we believe is a more efficient, cost-effective approach to the public capital markets for small and medium enterprise in Canada. We've walked in the shoes, literally, of the issuers that we work with to bring into the public capital markets. I've included background materials in the remarks, which give the size of the organization and our development over the years. But as of this morning, we've lost 2 companies since I submitted the remarks. It was we're listing 737 active companies. No CPCs, no ETFs, no funds. These are all active corporate issuers. And over the last 5 years, the Canadian Securities Exchange has listed approximately 50% of the companies coming into the Canadian market. So as we think about the issues confronting public capital in Canada, we need to understand our position in the world. And again, we talk often about the uniqueness of the Canadian marketplace. And one of the issues, of course, is the very high retail participation rates in these markets, particularly in the early stage capital markets in Canada historically. And in truth, our only peers from the participation rate level are the United States and Australia. And we can't be drawing conclusions from other markets because, again, they are too different. They just don't have the retail participation that Canadians offer to companies looking for growth capital. And they've been very important. We've obviously built the mining industry in Canada with a tremendous support from the retail sector. We saw the legal cannabis industry in Canada and elsewhere funded principally by the retail sector. And more recently, blockchain, AI, cryptocurrency sectors have been funded principally by the retail sector in Canada. We also need to think about or understand the interplay and where we are between public and private capital sources. So private equity in many respects can be seen as a continuum or part of the overall process, or at least that was the way people used to think about it. Early stage companies would receive angel funding. They would see venture capital in the very early stages. And then when they were appropriately mature, they would come into the public capital markets, providing a liquidity event for the early investors. Increasingly, that is not the case. And in fact, what we are seeing is that private equity sources are increasingly more competitive than public capital sources for a variety of reasons that I get into in the remarks. In the first instance, we've effectively cut off retail capital from accessing early stage investment opportunities in the public markets. Self-directed investors, by definition, can't participate in IPO or pre-listing funding. Accounts which are managed by investment advisors, large Canadian financial institutions, generally speaking, will not recommend participation in these investments for a variety of reasons that, again, we can get into. And in many cases, private equity is prepared to offer higher valuations than the public markets are, who traditionally look at a discounted future earnings as the chief way of evaluating a company. Instead, the private markets are really looking at growth, and they'll figure out how to get to profitability at some point in the future. So appreciating that the company or the committee has time limitations, and the interesting part of this conversation will clearly be in the question and answer period, a few rapid fire high impact issues that I've set out. Clearly, as Mr. Creech pointed out, tax policy is critical. We have to be convinced that the overall rate of personal income tax supports the productivity and investment goals in Canada. We may not measure up very well in that regard against some of the competitive economies. We know for sure that individual investors are extremely sensitive to changes in capital gains policy. With the proposed increase in the inclusion rate in 2024, we saw the tap virtually run dry. We agree completely with the TMX Group's positions on flow-through and shred credits and the mineral tax credit. It is unforgivable that we continue to have the flow-through program approved on an annual basis only, providing the kind of uncertainty that was referred to by Mr. Creech. Again, in the conversation, we'll get into, I think, some of the detail here, but the traditional IPO is dead, and it's not coming back for small and medium-sized companies. We've seen a complete abandonment, I guess we could call it, from institutional capital of the early stage market. Canadian pension funds don't buy small cap stocks. We really do need to take a look at the existing support programs too. Levels of government across Canada are exceedingly generous, with a number of different industry groups which have been identified as critical, strategic, or whatever. It's not clear that we are properly evaluating the effectiveness of those programs, and in fact, we may be crowding out public investment opportunities. And one of my big concerns is that we're creating a farm team for U.S. venture capital and private equity, or trade sales. And last but not least, harmonizing provincial securities regulation. It is, in fact, one of the biggest trade barriers that exists in Canada. Mr. Creech referred to the CPC program, which is the most popular means of going public on the venture exchange. The Canadian Securities Exchange cannot do or offer a CPC program because the Ontario Securities Commission, one of our principal regulators, is opposed to that means of accessing public capital. Mr. Creech's exchange is not regulated by the Ontario Securities Commission. He's regulated by BC and Alberta. So just a simple example of how lack of harmonization of regulation can access or impinge access to public capital. It's a tool that we cannot use. And last but not least, I have some thoughts to share, and I'm sure we'll get into the conversation about offering greater access, retail access to private equity as a means of solving some of these issues. Safe to say we are not in favor of many of the measures that have been proposed over the last few weeks, and believe that we should instead be focusing our effort on important reforms to the public capital markets and improving retail access to those financial opportunities. Thank you, Mr. Chairman.
So thank you to both of you. Very informative opening remarks, I will say. So I think we will have a very interesting session. So colleagues, we have a 45 minutes left, so I suggest maybe to limit to 5 minutes each for us the first round, and we will see if it's possible to continue after that. So Senator Veronier, our Vice Chair.
Thank you. My first question, hopefully I'll get two in, but Mr. Carlton, you know, it's been my experience, and I'm I only read about the public markets, not very much involved, but you're never rewarded for your abundant successes, but constantly vilified for the rare failures. And the question in terms of compliance enforcement against the bad actors, does the Canadian Securities Exchange have the right tools and the right capitalization to investigate, pursue the bad actors, bring them to justice? Are the penalties commensurate with to the infractions, or do the bad actors feel it's just the cost of doing business?
Well, you may think it's a fairly simple and straightforward question, but the point of the securities regulation in Canada is that it's actually a multi-layered approach. So at the top of the heap, you have the securities commissions, who have broad powers of investigation, resources to police, investigate, and ultimately prosecute the bad actors. On the market supervision perspective, we have the Canadian Investment Regulatory Organization, or CIRO, and they are the police. They police activity on the market, so trading conduct. And the principal folks under their jurisdictional purview are the dealers. And so they're looking at trading across all the markets, the venture exchange, the CSE, and so on and so forth. Canadian Securities Exchange and the other exchanges in Canada, our primary jurisdiction is with the issuers. And so with the assistance of the securities commissions, we are primarily ensuring that the continuous disclosure provided by those companies is up to date, and that in terms of accuracy and so on, that's in many respects up for the market to determine, or at least to value the risk of the information that is being disclosed. But we are working constantly with CIRO and the respective securities commissions, whether it's on the investment side, the trading side, to keep, as you described them, bad actors, or at least certainly behavior which is contrary to the interests of the marketplace, at bay. Our jurisdiction as a self-regulatory organization is really limited to the issuers, and we have very limited tools to punish the bad actors. In many cases, the only tool that's in our kit is to suspend the company from trading. And so as a result, that in some cases can be unfortunate for the existing shareholders of the company if they're deprived of a market. So it's a bit of a blunt instrument. It's CIRO that has the power to, as I say, work with the dealers and eventually have fining power and deprive people of their registrations, and the securities commissions who have the power to extract additional fines and in fact jail sentences if those are called for in those particular cases.
You see that?
Round two.
Second? Okay, thank
I'll
you.
see the balance of my
Colleague,
time too.
yeah, Senator Friedlander.
Thank you for your introductory remarks and joining us today. Those were very helpful. There was an allusion to the barriers of retail investors participating in the marketplace, and the balance between KYC and KYP, in my view, and then some of the exempt thresholds is overkill on the part of the regulators in terms of allowing market participation. Earlier witnesses have said we let people buy cryptocurrency, we let them go to the casinos and they can blow their brains out, but we don't let people participate in the junior markets. And I'd like to hear your comments on from both of you on just the over-regulation or the extensive barriers to people getting into the junior market.
Go ahead,
sure.
Andy.
Okay. Thanks, Richard. And thanks for the question. Yeah, we do see that a fair bit. So obviously, decreasing regulatory burden would definitely enable more retail participation in the markets. There are subscription forms that investors need to sign to participate in financings that are extensive, and then there's the burden on the regulatory side in terms of the brokerage houses that do play in the public sector still. And then they have oversight by their compliance departments as well. So having someone participate in a relatively modest financing for a venture-sized issuer is extremely difficult, as you'd noted. And again, with a self-registered funds, it's hard for them to participate without actually having these broker accounts. And then also the gamification that's out there right now. There's a lot of alternatives. People are investing and making that, taking their risk capital and deploying that more in the online phone gaming apps that are out there.
And Senator Friedhandler, you're absolutely right. We have seen a migration of how early stage capital formation takes place away from the IPO to the non-offering prospectus. And so what happens now in just about every case where a company is coming public is that it will raise the money privately using the typically the exempt investor or accredited investor, depending on whether you're in the United States or Canada, exemption to the prospectus requirement. And so that money is raised from, in effect, wealthy people, and in many respects from offshore as well. You will note from some of my materials, a lot of participation from the United States, from Western Europe, from offshore, as well as BC and Ontario being the two largest contributors to capital formation in Canada. But what happens is that these securities will be distributed privately to a relatively small group of individuals and funds and family offices and so on. And then they will do the non-offering prospectus to qualify the securities for listing on the exchange. And so then when they come onto the exchange, they tend not to have as broad a distribution as they would get under the IPO. So price discovery is harmed. Volatility is, generally speaking, increased. And it can make it a little bit more challenging for the company to raise follow-on capital as a result of that relatively thin public market that they have. The benefit, of course, of the IPO is that you see a broad inclusion in that offering, significantly more shareholders, better liquidity, better price discovery, and a better opportunity for the company to raise secondary funds once they're in the public markets. So I should add, last year in Canada, there were 10 IPOs. The CSE did 5 of them, raised a grand total, in our case, of, I think, $8 million of those 5 IPOs, which tells you all they were doing was qualifying securities which had been already or previously issued to investors. This year, in the first 2 months, there have been 3 IPOs. All of them have been done on the Canadian Securities Exchange. So again, that market has, as I say, effectively dried up, because who would you syndicate the offering to? You're not going to syndicate it to the, in effect, bank retail clients. Obviously, the self-directed money is off limits completely, and that's where the majority of the retail assets are going. ETFs aren't going to be buying a new offering, or the old mutual fund money used to be. And the only time you're going to see institutional participation in an IPO is when the company has reasonable prospect for joining the S&P TSX Composite Index.
Thank you. Maybe second round. So Senator Deakin to be followed by Senator Lafreda. Senator Deakin.
Thank you, Chair, and thank you, Mr. Carlton, Mr. Creech, for being with us. Really excellent testimony so far. We did a report 3 years ago called Needed, an Innovation Strategy for the Data-Driven Economy. We saw a lot of challenges facing Canada's highest growth companies. And one of the ones that I've certainly seen as someone who's come from that space is the need for a liquidity event as early investors get to a certain age of the investment that they put in, and that's usually put into their deal when they're putting the money in the company. And liquidity events, inevitably, what dominates is acquisition by a foreign entity. So we don't get that future growth. Just as these companies are starting to scale and they got their go-to-market strategy clear, raising money to really put the pedal to the metal and grow their companies, we lose them. And as somebody who started his career in the investment industry in the 70s and 80s, I see a huge vacuum around independent investment dealers. We used to have a vibrant owner-operator market of investment dealers across this country that would have participation in early stage investments. But now it's really, the industry is entirely dominated by the 6 big banks, and it seems a regulatory structure suits the banks because it's a very heavy regulatory structure that is the burden is too much for our independent dealers. So as part of the issue that you've been speaking about, Mr. Carlton, and I think we spoke about earlier, Mr. Creech, how do we start to reverse that trend and get all the decision making away from 6 stores and broadened out to a number of owner-operator, the independent dealers that are run by those who are putting their own money at risk? Start with you, maybe Mr. Creech, and move to Mr. Carlton. Thank you.
Great, thanks for that question. You'd mentioned a liquidity event, and the TSX Venture Exchange, yes, we're a public market, but when issuers list with us, they're not listing for a liquidity event on day one. The TSX Venture Exchange is a growth platform. It's where small enterprises can come and list, access capital, use their shares for acquisition, so they can either pay cash or issue shares that have a quoted trading price to build their business. Usually it's like combined with a roll-up strategy where they're accessing capital from the markets and then also acquiring other entities out there. And then as it relates to like growing their business, it's a 2-stage process where they then execute on their business plan, have some success, move to the TSX and graduate there, and then access broader pools of capital. As it relates to possibly being taken out by other enterprises south of the border or deeper or private pools of capital that are out there, as Richard had mentioned at the start of this, sometimes they can find a better valuation in the private markets. So what makes it more interesting for management is we have to set the preconditions to make investing in the Canadian capital markets more interesting. So that's the tax reform. That's supporting the market infrastructure out there as well. Because when you invest in infrastructure, not only just roads, bridges, and airports, invest in the Canadian capital markets infrastructure as well. And we're doing our part as well in terms of last year we invested in critical CDS clearing platforms, so to make the technology more efficient to clear all the trades and settlement from that perspective.
Mr. Carlton?
I think we have to figure out how to unleash the retail capital that is available. And yes, some of it is with the independent dealers. Some of it, a good deal of it, is actually in the self-directed accounts, which are either with the disruptor brokers or inside the big banks. And a way to do that is by looking very carefully at the accredited investor and definition or exemption and broadening it. As you say, we let people who are in a disruptor account buy crypto or other high-risk investments, yet we deprive them of the opportunity to invest in pre-public offerings, like a distribution done through an exemption to the accredited investor definition. And again, getting back to provincial or interprovincial trade barriers, in some provinces, they have expanded the definition and they permit individuals to self-identify, self-certify as accredited investors. In Ontario, we can't. So again, if you're running a national brokerage operation, whether you're a large bank, independent dealer, or whatever, it raises the risk and compliance issues associated with attempting to put those dollars to work. So I think that's a key area that we can look at. And certainly Mr. Creech's comments about tax policy is absolutely critical. And again, I echo the concerns that you've expressed, which is we're seeing a lot of private companies which have been funded, supported through a variety of programs, which never see light of day in the Canadian public markets. Instead, they're looking for a trade sale or a quick trip down to Boston, New York, or Silicon Valley for a seed or an A round from a US-based VC.
Thank you. Sorry to interrupt. So I think that we try to have one economy, but it seems that we have not harmonized regulation in this country in the capital market, as you know. So Senator Lefreda to be followed by Senator Henkel.
Thank you, Mr. Chair, and thank you, Mr. Creech and Mr. Carlton, for being here. Excellent testimony. Mr. Creech, in your opening comments, you did mention that in your opening remarks that Canada's most public companies are SMEs, which is unique to Canada. Mr. Carlton, you mentioned that the IPOs are dead. They're not coming back for SMEs. And I'll continue with Senator Deacon's question later on, but you would both agree that access to capital is a major concern for our SMEs. And the federal government, through the Canada Growth Fund, is purchasing shares in public companies to support the critical minerals sector, which is extremely important. Should they do the same for SMEs? Would that increase the listings? Should they play a more significant role in supporting them through the investment in capital markets? And they currently do through the federal loans, where the BDC, they play a huge part there. And I hear many of my counterparts, former clients tell me that it's very helpful. But, it's concerning because once, to Senator Deacon's point, once the outside investors come in, the return on capital becomes an issue. And when it does become an issue, you either go public or sell your company. And we all know, without mentioning those numbers, I've done it a few times in the bank committee here, where there's a lot more liquidity outside of Canada than there is in Canada. The statistics do show that when you do sell your company, many of the investors are outside of Canada. So should the government play a bigger part in supporting the SMEs? And what can they do to encourage Canadian acquisitions of Canadian companies? We've got two significant leaders in our industry here this morning, so I'd like to have your points on that. And if we can do it in the first round, the second round. Mr. Creech, maybe we can start with you.
Terrific. Thank you very much for the question. So you mentioned a few different things there, the deployment of the Canadian Growth Fund and BDC. And we do see the BDC participate in some of our issuers, particularly in the growth and innovation sector. Not as much on the mining side of things, but we do see issuers that have reached cash flow status participate with funding from BDC. So I would definitely like to see that. Again, we want to create the right conditions where we can decrease the regulatory burden, make it easier on issuers to go public and stay public. So the introduction of the semi-annual financial reporting, make that available to all venture issuers. And then also, you talked about liquidity. 40% of the liquidity that happens on the venture exchange generates from outside of Canada. So it's an international marketplace where we have a lot of eyeballs from Asia, from Europe, from the US, Australia. So there is a lot of participation across the globe in the marketplace there. So again, going back to my opening comments around the tax reform as well, providing incentives for people to participate in the Canadian capital markets will beget that. And we do see Canadian or venture companies merge with other venture companies as well. And so trying to keep that successful listing in Canada sometimes also generates spin-offs from those. So you might have two issuers that own part of the same project and a mining issuer. They'll come together and form a larger mining company and then spin out those. They might have a portfolio and they're interested in one or two key properties. Spin out some of those smaller properties to generate another new listing to keep, effectively two listings in Canada over time. So make it more incentive and decrease the regulatory burden to enable that by. There's duplication right now in annual information forms and MD&A disclosures. So try to rationalize disclosure requirements for these issuers, because if there's a bunch of duplication, that means you're paying lawyers to look at 2 or 3 sets of documents that are saying the same sort of information, so making it easier that way as well.
Thank you. Mr. Carlton, any comments on your side?
Yeah, in 1 minute, if it's possible.
In 1 minute, yes.
Oh, well, I think the single best thing that the federal government could do is create the conditions, and I'm mining focused for a second here, that remove the or address the infrastructure issues that the mining industry has, particularly in Ontario and Quebec. So access to power, roads, shipping facilities, rail. And the key one, of course, is getting funding for smelting and refining. That will open up the exploration side, because they're suffering as a result of a lack of clarity on how you're going to get their products to market, if, as and when, in fact, they move from the exploration to the production phase.
Thank you, colleague. So, Senator Hinkle, to be followed by Senator Warren. Senatrice Hinkle.
Merci, Monsieur le Président. J'aimerais vous poser
Thank
une
you,
question.
Chair. I would like to ask you a question on statistics. Do you have any recent statistics on the success rate or failure rate of IPOs for SMEs over the last 2 years?
We've talked about IPOs a couple different times at the meeting so far. On the venture side of things, we did have over 70 new listings last year. In terms of IPOs, there was less than 5. So I talked about the capital pool company program and qualifying transactions. We had 28 new listings via qualifying transaction, and we had about another 30 or so via reverse takeover type transactions. So in total, 70 new listings. And then on the TSX side of things, their new listings were primarily graduations from the TSX Venture. So notwithstanding that the TSX didn't have very many IPOs last year, they did have over 10 graduates from the venture side of things. And then in terms of statistics, just overall, to paint the picture, in 2015, the total market cap for venture side of things was $40 billion. And in 2025, the total market cap was $152 billion. And then, so just in 2015, the average market cap per issuer was about $12 million. In 2020, it was about $40 million. And in 2025, it's approximately $100 million. Yeah.
Merci. OK. Deuxième round. Vous avez encore du temps si...
You still have more time, if you wish. So there's some countries in the city, Australia and France and Italy. I want to say that they have re-examined their regulatory framework in order to facilitate access to growing businesses to the capital markets. Do you have an idea about what reforms we could find inspiring for Canada and also applicable in Canada, which could be put into place by our governments quickly and easily? If they've done it, maybe we can do it, but which would be the simplest ones to adopt in Canada?
Terrific. Thank you for the question. For Italy and France, I'm not too familiar with, but for Australia, they have the semi-annual financial reporting, and that's something that the CSA has proposed, and we strongly support that to make it available for all venture issuers. In terms of for the federal government, it's the tax reform that we talked about after the opening there. The shred credits that are now available for public companies, that's proposed to go through in the next budget. Strongly support that. Would love to see that happen. And also providing tax incentives for investors to make it efficient and economic for them to participate in the Canadian capital markets, so make the capital gains rate effective there.
Mr. Carleton?
I can... Australian market, we actually purchased an Australian exchange in October of last year and are in the process of building out a venture market for Australia. One of the major differences in Australia is that their pension funds actually still buy individual stocks. So they opted not to have these behemoth Maple 8 style pension managers. Instead, there are roughly 38 to 40 so-called superannuation fund managers who are all small enough and nimble enough that they are, in effect, making active bets in the marketplace regularly and purchasing small and medium-sized cap stocks. That provides for a much more liquid market. It means that offerings to the market are actually well supported, not just by individuals, but by institutions as well, who are supported by research analysts and so on. And at this point, I believe it's the participation of those institutions that, in fact, provide better market valuations for equivalent companies in Australia than you see in Canada. So what we are seeing now are a number of folks, Canadian companies, which are looking to access that liquidity, but also the better valuation by cross-listing their securities in Australia. And that's something that we're looking to take advantage of with the exchange that we've acquired in Australia over the last year.
Thank you. Maybe in the second round we could explore a little bit more that. I found that very interesting. Okay, Senator Wallin to be followed by Senator Youssef. Senator Wallin.
Thank you. I have two questions. I'll start with Mr. Carleton. You Everybody's in general agreement here about the tax issues, tax credits, the capital gains, which I think is 3 times higher in Canada than it is in the U.S. And then you specifically said that when it came to retail access and recent events in the last couple of weeks, signals that you've been receiving from government and/or markets. Can you be explicit on that? What things are concerning you directly? And then I have a question for Mr. Creech.
I'm actually not sure what you're referring to, Senator Wolin.
Retail access, and then you said there are recent moves that give you pause and that create concern. I don't know whether that's on activity of pension funds or what you were referring to.
Nothing within the last few weeks. This is a trend that we've seen really over the last maybe 10 to 15 years. And it's how we've seen steadily, and Senator Friedhandler referred to this, the regulatory structure around how retail accounts are regulated and managed by the institutions that are offering those services. And what we've seen is a dramatic narrowing of in effect, what's on the shelf for those investors. And in many respects, if you're at a big bank, and I believe there was a story to this effect in the Globe and Mail this morning, those investors are limited to products which are developed by that particular institution. They're not going to recommend individual stocks, even ones that are already trading because of the know your product rules. And they're certainly not going to get access to an issue which is being marketed by another dealer to raise funds for, whether it's a mining company, life sciences, AI, quantum computing, or what have you. That's simply not part of the environment that we're in now, and those companies have to look to other sources to secure that capital.
Mr. Creech, is just to follow up on earlier comments from Mr. Carlton, where he said, governments are dead. What we're doing is kind of creating, because government funds may be generous, but we're not assessing what's successful, that we end up being a farm team for the U.S. and investors there. Is that your experience? Do you have numbers on that it's actually, you're having a lot of people come in, but how long do they last and where do they go?
Thank you for that. We do actually invest in generating new listings from around the globe. So we have people positioned in Israel, the UK, a couple people in the US, one in Australia. And we do drive business from and help support US businesses list in Canada, access Canadian capital markets. And we've had over 200 companies actually list up here to provide Canadian investors, retail and institutionals opportunities in some of those growth sector stories. If you were to go to a U.S. CEO and say, hey, do you want to list in Canada or you want to list on NYSE NASDAQ? They're obviously going to say NYSE NASDAQ. But the venture is a growth platform where we can provide those early opportunities. There is no equivalent to the venture exchange in the U.S. It's just those two big boards. So by providing access up here, we get Canadian investors and retail access to those growth stories early. They come up, raise $2 to $10 million. They then execute on their business plan, probably last 2 to 5 years on the venture exchange, graduate to the TSX. Then they generally seek an interlisting at that point when they're able to qualify with a NYSE, so they're dual listed in Canada and the US. And then it becomes a function of where the trading happens after that. If 98% of your trading is happening in a foreign jurisdiction, then the issuer will move to that foreign jurisdiction. But if you can still show a decent amount of volume, then they'll stay listed. So in theory, in general terms, someone coming from abroad and listing up here probably lasts between 5 and 8 years kind of thing.
Thank you, Senator. So Senator Youssef to be followed by Senator Sranget.
Thanks. Thank you, Chair, and thank you both of you for being here. Given the size of our country and population compared to the U.S. and other much larger, is Canadians less risk averse in early stage capital venture because of the size of the country, because people are more worried about the risk that they're taking, but equally recognizing that we're a small population, so you don't have the level of interest that people would have when you compare to the United States. Is that a problem? And secondly, given of course the U.S., of course, a longer history in terms of its support for SMEs and growth for smaller companies. Does this present a huge problems in terms of how Canadian companies quite often get bought up or taken over by, quite often by U.S. companies, because they see they don't mind investing because they can see the return on the capital in the long term and have a longer interest compared to when you look at Canadian investor?
That's great. Thank you for that. So a couple things there. CEOs, if you can show them access to capital and liquidity, they will list. So if we can set the preconditions to make it worthwhile for these issuers to actually access the capital they need, then they would stay in the jurisdiction. So if we can make it more favorable for those issuers to stay here, then they will, because they can tap that pool of capital. In terms of Canada overall, we're actually doing very well. We're punching way above our punching power is quite strong. Like, we're in top 5 in terms of the globe, in terms of the number of listed issuers, number of new listings, amount of capital raised. So we're doing very well in terms of that globally. But we can always be better in terms of being able to create a stronger financial market for Canada. And so those tax regimes that I'm talking about would help then bring in more broader pools of capital to support those issuers, so they might not need to go south early.
Mr. Carlton?
And Senator, if I could offer, I don't believe that risk aversion is an issue in Canada, nor do we lack entrepreneurial spirit. In fact, Canada generates more company starts or business starts per capita than any other nation on earth. And we are, as Mr. Creech mentioned, in the top 5 in the world in our public equity market, in effect, the size of our public equity capital markets. Now, the challenge is, and I'm right now on the 72nd floor, First Canadian Place, looking across Lake Ontario, I can see New York State, and their capital market is 14 times our size. So yeah, there is a gravitational pull to those markets for very specific kinds of companies. Right? It's not all companies. Mining companies aren't going south to the United States to raise capital, but certainly in very fashionable sectors, they are. And as I say, we need to have that infrastructure which enables these companies to get from that startup phase into the public markets and afford Canadians the opportunity to enjoy the growth that comes during those fast-growing times of the company's development.
Thank you. Yeah, 1 minute.
Given our relationship with the Americans right now, do you see any of this manifesting in the marketplace currently?
Yes, for sure. The political instability out there right now and geopolitical situation, people are looking for safe havens. So there's a lot of demand for gold and silver, and the venture exchange strongly supports the mineral sector. So we've seen a lot of capital deployed into the venture space. In financings last year on the venture, we had over $10 billion raised. That was the top 2 years over the last 15 and top 5 over the last 25 years. So there was a lot of flow of capital into the Canadian capital markets to support those mining issuers. Those are management teams predominantly based in North America that are supporting and developing projects around the world. So we've seen a big flow of funds in as a result of that.
Thank you, Senator. So, Senatrice Ringuet.
Merci, Monsieur le Président.
Thank you, Chair.
Strong in voicing our support to the removal of interprovincial trade barriers, and there's a buy-in from all the provincial premiers, and the premise is that one province will accept the standard that has been established in another province. And from your comment, Mr. Carlton, I believe that you have seen no movement in regards to removing any kind of barriers from the Provincial Securities Commission. Am I right? And how would you see this premise of accepting the standards of another province on the security scale? Thank you.
So my colleagues at the securities commissions would be horrified if I was suggesting that there was no progress. But the progress that we have had is spotty, slow, and not as effective as it ought to be. And as I say, Mr. Creech and I can lay out any one of a number of examples of how barriers between the provinces raise the cost of capital for companies, interfere with their ability to raise capital in Canada, and genuinely, as I say, cause friction in the marketplace. Again, I think I was certainly in favor of Mr. Flaherty's project to create the National Securities Regulator. As we know, it's a long, complicated, unhappy story as to how it did not come to fruition. Again, you'd have to ask the provincial securities regulators why they were not able to come to a consensus on specific issues like definition of an accredited investor. The rules around crowdfunding, again, are different all across the country, which makes it impossible for anybody to run a crowdfunding platform in Canada when there's one set of rules in the United States for that capital market to provide these vehicles to raise prospectus exempt capital from individuals. So yeah, we do need to tighten our game. People are looking at it. There are efforts, and the move to provide semi-annual reporting for some public companies is an important first step. But it's very slow, and it's inconsistent, and we should be doing a lot better.
On that question, yeah.
Yeah, if I could just jump in on that, Mr. Carlton, raised some great points there. Just stepping back a slight on that, the global perspective around Canada right now is that there's fragmentation. There's 13 different places that you need to deal with versus, the benefit of walking up and dealing with one window. So be that as it may, regulators need to harmonize as best as possible to operate as one system. And currently there is a passport system, so if companies want to raise capital and file a prospectus, all of the jurisdictions are participating with that except for the OSC. So it'd be great to see the OSC join the passport system. Then if you don't have a national regulator, at least they're all playing as one at that point in time. So that would be something that we would strongly support as well.
Can I do a follow-up?
Very quickly.
Yes.
Yes.
Mr. Carlton, if you could provide us, you say that the cost of not moving forward with harmonizing or removing the trade barriers, particularly for trade, with securities, you said that you've identified the list, and have you also identified a way to move forward for the provincial governments in regards to the securities?
Well, there are pain points that we have identified and are actively working with them on. They have their own priorities at a provincial level as well as nationally. I'll give you another example. Province of Quebec requires, of course, not surprisingly, French language documents, official French language documents for the company's disclosure. That's really expensive and adds to the cost of capital. As a result, Quebec is bypassed on many of the offerings that are in fact conducted. An unintended consequence, perhaps, but as I say, companies are realizing that the investment is perhaps not worth the expense of raising capital in Quebec.
Could you provide to our clerk the information I just asked you? I think it would be very helpful for our committee.
Thank you, senators. Colleagues, any other senator want to intervene to this first round? Because otherwise we will have 5 minutes left and have maybe just yeah, exactly. But just before to go to the second one, so if I understand correctly, so we have barrier between provinces, which is not helpful. We have this QYC, QYP, which is explain why retail investors are not really there. And we have this big pension fund that people explain to us that, it's the same time for small company, big company, and Canadian market is for them not really as attractive. So I'm optimistic by nature. I've worked during 25 years in the capital market with National Bank Financial and so on. So we have to find a way here at this committee with our recommendation and observation. We will have the regulators who will come here around the table, and we will hear that. Maybe we have to think about as well invite pension fund because they have the huge capital regarding that. So we go to the second round. Colleagues, we have 5 minutes left. What I propose is we have Senator Vernet. I have to identify Friendler, Lafreda. Okay, Deacon. Okay, here my suggestion. 30 seconds each to ask your question, and the witnesses will answer or decide which one they reply. So start with your question, and each senator will ask their question, and you will reply at the end, okay? Senator Friedland, Veronique, sorry about that.
Thank you. I mean, I fully endorse the harmonization of one federal regulatory regime, but does compliance follow that as well in terms of one federal authority across Canada? So the question is, how do you intermingle regulations, the regulatory body and the compliance body? Is it all one and across Canada, or do we leave it as sporadic as you highlighted in your answer to my first question?
Veronique. So please take notes because maybe we'll need a written answer from you. Senator Friedlander.
I hear all the time the costs of going public, and people would rather stay private and grow their companies. You've identified semi-annual reporting as a cost saving from the quarterly and annual. Are there other things from the stock exchange perspective on the cost side of the equation that can be improved upon, whether it's adjusting regulations or adjusting your rules or whoever can influence it?
Thank you, Senator. Senator Lefreda.
Thank you. So we have an extremely low number of IPOs. Is there any long-term consequences for the Canadian economy? And when it comes to policy tools that the federal government could use, which ones work best? Well, tax incentives, like we used to have the QSSP in Quebec, and that's no longer there. Would bringing back some of those tax incentives improve access to capital for our SMEs and increase our listings?
Thank you, Senator. Senator Deacon.
Focused on businesses that are not in the tangible sector, not resource businesses, but are high growth, digital and technology-based businesses, where Canada has really fallen behind in the ability to fund the growth of those businesses. And that is where there are non-tariff export opportunities around the world where we do create those companies, but they migrate very quickly out of the country. And so just your specific ideas as it relates to that. Thank you.
And the last question is Senator Youssef.
Yeah, I mean, we hear a lot about whether or not a company want to go public or remain private. I mean, I could understand if I'm the creator, I want to keep my company private. What's wrong with that? I mean, I could hear the argument for going public, but maybe you can share some of your thoughts in regard to the obvious question as to what are the advantages and disadvantages.
Okay, so for the benefit of our colleagues and people watching us, why not, if you could take 2-3 minutes each and pick the question you want to answer and follow by written answer if you can. So I will start with you, Senator, Mr. Creech, please, 2-3 minutes maximum to react to any of the question that you can choose.
Okay, great. So to your question about why public, why private, there's obviously you give stuff up when you go public. You have to disclose everything. So when you're a private company, you can do certain transactions and not need different approvals. But to go public, obviously, they're generally trying to access pools of capital to grow their business and leverage using their share capital also as acquisition tools. And also has prestige as well. We've heard numerous times that when a fledgling company comes on, lists with us, they actually get meeting opportunities where they wouldn't have gotten them before because they can say that they're listed on the exchange, and that can get them access to new contracts to bid on and whatnot. So it provides access there. The cost of going public was one of the questions. To improve that, obviously decrease the regulatory burden. I mentioned before around disclosure. There's a lot of duplication out there around disclosure regimes. We are definitely big proponents of market integrity, and we want to make sure that the investors and shareholders have the information they need to make investment decisions. But do they need a 30-page disclosure or subscription agreement to sign off to be able to participate in that transaction? And also, again, just to mention that semi-annual financial reporting, there's a proposal out there. It's to be limited to certain venture issuers. I think it should be made available to all venture issuers. But kudos to the CSA for proposing that term overall. And then it goes to compliance question earlier about intermingling if you went with one regulator or not. We do have a sophisticated compliance team at TSX and TSX Venture Exchange comprised of chartered accountants, securities lawyers, geologists to review the applicable disclosure that's out there and also to vet the principals that participate in their market. We get personal information forms, do background checks on all these individuals to make sure there's integrity there. When we get shareholder complaints, review those, and depending on what we need to, if it affects a transaction submission that we have, then factor that into our decision making. And then if we find actors that are acting in bad faith, refer those to the securities commissions. The securities commissions are the sheriffs in terms of being able to actually make judgments and fines and other requirements there. And the innovation sector, just wanted to point out that this year, between TSX and TSX Venture, the mining market cap hit a record of over $1 trillion, which was amazing. On the growth sector side of things, that sector hit a record market cap of $97 billion. So we had both sectors hitting record market caps this year. So we are definitely trying to diversify our listing base and are working with issuers in the tech and growth sectors all the time, trying to get more opportunities for Canadian investors to participate in those growth stories.
Thank you. Very concise in 3 minutes. Congrats. So could you do your best as well, Mr. Carlton, in 3 minutes to react to many questions you have received?
Yeah, first thing from the regulation perspective, it is national effectively now. The exchanges are operating nationally. CIRO, the market regulator, is operating nationally. CPAP, the overseer of the accountants, are operating nationally. It's just the securities regulation that is the issue. And again, that's where the intention, I believe, is required. Really, all of the other questions come down to question of cost of capital. Who's providing a lower cost of capital at a given time? Is it private investors? Is it the public markets? And TSX, TMX Group, and us and other participants in the field are looking at every way we can to reduce that cost. There are a couple of things which I haven't mentioned, which address other countries. The United States implemented vast new avenues of prospectus exempt capital that permit individuals to participate under the so-called Jobs Act, so Regulation A and Regulation A+, which permit companies to raise $50 to $75 million, and those numbers have been increased without a prospectus and going directly to individual retail investors. Capital gains is obviously, I think, the biggest tool in the federal government's arsenal to encourage or discourage investment from individuals and others. And really, the comments on cost of capital apply every bit as equally to the knowledge-based industries as it does to the manufacturing and mining space. Again, what we are seeing more and more often now are Canadian entrepreneurs who've been to the U.S. VC private equity mill 2 or 3 times and actually saying, you know what, I don't want to do that again. I want to look at a different approach. And, I'm prepared to take the plunge into the public capital pool. It's not all sweetness and light and valuations and all of that stuff. There are some real challenges for companies. And in many respects, running a public company in those areas, Senator D, can give you more control over that enterprise than if you are subject to the whims of the VC or private equity fund that is your controlling shareholder. So again, we do have advantages. It's not all doom and gloom. We are continuing to address these costs and attempting to attack the issues as they arise. And again, as Mr. Creech said, we punch way above our weight as a country in the public markets. and we are going to be an important part of the economic future for Canada.
So, on behalf of my colleagues and myself, we want to thank you. This session was very informative with you. We appreciate very much your testimony. You will be very helpful to identify, maybe for us, some witnesses that we should invite, and maybe analyze a little bit more what's going on in the U.S. market to understand more, maybe some changes that we could, and just increase the relevance of this special study. Okay, thank you. So, colleagues, we will suspend a few minutes in order to for the next panel. Thank you, both of you.